If you want to break into real estate and do not know how, you need to watch this video.
Down that shit, no drip, it's run it on, no sleep, no rest, might crash, might wreck, but first I stretch, run it on.
It seems like new people are really focused on interest rate, but they're missing kind of the bigger picture, right? Because there's so many different aspects that go into a loan when you're approaching real estate from an investor perspective, right? So investors and the more experienced people are looking at the ability to customize a loan to fit their needs. Because when you're an active real estate investor, being locked into a loan and having your equity or your capital kind of locked away, it's not really conducive to how they live their lives. You need to be agile, you need to be flexible, you need to have the ability to act quickly, right? So using banks and using other people's money is usually how people get wealthy and rich. They leverage. It's called leverage, right? So leveraging banks' money at a cost, that's what you cost for the money, right? So the interest rate is the cost of the money. How long in the terms of that loan is really essentially what you're paying for. So if you're just focusing on an interest rate, you can tend to miss the bigger picture, which are the prepayment penalties. Prepayment penalties are a killer, right? So commercial loans usually have prepayment penalties attached to them. And they usually start at 5, 4, 3, 2, 1. A 5-year prepay means if you pay it off or refinance in the first year, you get banged with a 5% penalty. So 5% on the total loan amount is a lot of money, right? Then it goes down to 4% your second year, 3% your third year, down to 2, down to 1. At River 6 Lending, we have the ability to structure and fully customize loans. So if an investor is planning on getting in and getting out or selling or refinancing within a year or two, we can remove a prepayment penalty with that in mind. Now that's going to increase the rate because that is leaving the bank more at risk of not making the money they want to make on these loans. But if he has a game plan of, listen, I want to buy this property, when the market goes up, I'm going to refinance, and I plan for that to happen within the next 3 years, we're not going to put a prepayment penalty on his loan because he's going to end up losing, it's going to end up costing him money. So that difference in that interest rate is not going to compare to a 5% hit on a prepayment penalty. If you're a new investor, I'm sorry to say it, but there's no way to get into this business with no money, right? What you need to figure out is how much money does it cost to flip a property? How much are the carrying costs? What do I have to be worried about? So if you're working with a lender, he needs to be guiding you in that way. So whenever we at River 6 Lending, whenever we work with newer investors, we have to make sure that they know the benchmarks and things that they need to hit, right? So if you say, hey, Zach, I want to start flipping properties, right? So I'm going to say, okay, so this is how flips are structured, right? These are the three main these are the three main things you need to focus on, right? Purchase price, construction cost, ARV, and that stands for after rehab value, right? So as hard money lenders, we like to be in a 65% loan to value range, which means at that ARV, when everything's fixed up, that after rehab value, our loan and our skin in the game, we want to be at 65% of that, right? The lower the loan to value on our end, the less the risk. So lower loan to values are good on our end, right? So, but just the down payment isn't enough. So we have loans where we can structure it where you can actually wrap up all the closing costs and your monthly payments inside the loan. That's called an interest reserve. So we can structure the loan so you don't have to make any payments just for that 6 months or 1 year term or however long you have to do the project with us. You are just focused on execution and not worrying about paying monthly bills. So that's one of the tools and things that we do with newer investors, because it's really hard to break into this business because you're dealing with people that are experienced, that have connections, that are working with, you know, attorneys and have access to lists of property. So it's a very competitive industry, right? Getting and finding the deals at a consistent rate is the hardest part. So you need to have an ally, you need to have a team. Having an attorney, having a title person, having a lender, having a real estate agent, all these people that are professionals, that would be my advice to people just getting in. Assemble your team, assemble how much money you actually need to start. That will give you a safe cushion, and form a strategy. Am I going to fix and flip? Do I want to buy and hold? What is my goal and what is my plan? Develop those things, assemble your team, and that's how you break into working in real estate. When you fix and flip a property, it doesn't always have to end with a flip, right? So if I have a client that's buying a property, but it's a really good deal, right? It's off market, it's in bad condition, but he has a good team in place. He wants to buy that property. It's $300,000, right? And then it's going to take $100,000 to get it to fix it up and make it presentable so he can sell it. Now it's worth $400,000, right? But it's a two-family, right? And then he's looking at it as he's refinancing, as he's fixing it, and he's like, I would like to keep this property, right? So the value of that property, we can get 75% of that value, and he can keep that on a cash-out refinance. So instead of flipping that property, he can cash out, use that equity to purchase to the next home, and then he has a cash flowing property, and he owns it. So instead of flipping it, he refinances, takes the money out, uses that for the next project, and now he has an asset, right? So this is how, if you structure loans accordingly and look at it from different perspectives, different exit strategies, and have the ability, or working with a lender like us, where we can kind of change strategies in the middle of a project because it suits the end goal better, then it's good to have a flexible lender that has multiple different loan products so we can move on the fly.